Well, thank you, Paige, and welcome everyone. As Paige indicated, I'm Robert. We're here today because Kevin came up to me a few months ago at a conference we were both attending and asked me what seemed like a very simple question. Robert, what are adequate reserves? Well, as you know, boards make budget decisions every year, and the decision to update a reserve study to get the fresh information on how much reserves to be setting aside, that's a critical part to the budgeting process. And Kevin's in the D&O insurance business, so he's providing insurance to give peace of mind to board members that their decisions will be defended if challenged. So his question is an important one. Boards are responsible to run the affairs of the association, and part of that responsibility is to provide financially for the upkeep of the common areas. So providing adequate reserves to maintain the common areas is part of the board's fundamental responsibility. But for Kevin and the entire D&O industry to evaluate and defend the board's decisions about reserves, they first need a good definition of adequate reserves. But before I jump into today's material, let me remind you that this is a live presentation and everyone's been muted to keep the background noise to a minimum. Kevin and I are used to speaking to live audiences, so to get your feedback every once in a while, we may ask you to raise your hand, and you do that by clicking on the hands raised icon in your control panel that may look like the one you see on screen. And if you came with a question, or if at any time you have a question that arose due to something we've said, just type it in the dialog box in your control panel, and that will be something that Paige is monitoring throughout our session today, and she'll select from those at the end during our Q&A time. Well, I hope that you're taking notes. I expect to be taking notes while Kevin's speaking, but like all our webinars, we're recording this. So it'll be available on YouTube and our websites for future playback. Give us about a week and it should be there. Another resource is an outline of today's program that we'll send to everyone who fills out a brief survey at the end of today's session. So do please fill out that survey and make sure you add some comments about what you'd like to hear in future webinars. Kevin and I regularly present webinars, and we would like very much to be sensitive to the topics you feel are valuable or important. So without further delay, grab your mouse and click on the hands raised icon to let us know we're ready to get going. Give me a hands raised. Excellent. I see hands going up all across the list. Okay, thank you all. I'm going to click hands down. And here we go. Well, as I indicated, everything on a property is in a constant state of deterioration, and the boards are fundamentally responsible to manage the affairs of the association. And that puts the boards in kind of a interesting spot because the boards have a continual challenge to meet their responsibility to physically and financially care for the association when the assets are always deteriorating. And we know that serving on the board is a tough job for so many reasons, yet D&O insurance provides peace of mind, so the board members know they'll be defended if someone claims one of their decisions was a wrongful act. So we're here today to guide you with a simple plan to make both wise and cost-effective decisions on behalf of the association. Kevin's with us today because he's a national expert in the field of D&O insurance, and Kevin and I have been working side by side for the past 30 years, helping boards make wise decisions that will meet their responsibility to care for the assets of the association. The result is minimizing surprises and special assessments and maximizing peace and property values. That's what we want for you and your associations. And as I said a moment ago, Kevin challenged me a few months ago to define what it means to have adequate reserves. After a short discussion, we pretty quickly realized there was enough material here that we wanted to share a webinar on this subject with as many people as we could. Because as we all know, reserve contributions are good for the association, yet the evidence all around us is that with the deterioration and special assessments that we see, it's clear that too many boards are failing to set adequate contributions. They're convincing themselves with some common excuses. It's not my problem, we can't afford it, it's a problem for future boards, and besides, I'm insured. And unfortunately, that's the kind of flawed thinking that we'll address today.
Hi, everybody. I'm Kevin Davis. And Robert, I don't know if you remember this, but I met you about 30 years ago. I was the vice president of my condominium association called Old Vickery Square in Canoga Park, California. And it was a local trade show, my first local trade show I attended. I filled out one of those little forms and I won a free reserve study from you.
Fantastic.
And again, we've known each other ever since then. We've worked well together in providing education, information to the community association industry. And I'm glad to be here today. I'm glad to do this. It's been a while since we've done one of these, but I think this is a very important topic. I agree with you about reserves are so important. And those three things you brought up before is amazing. I remember I sold my first D&O policy about 35 years ago. And since then, I kept hearing those same excuses. It's not my problem. We can't afford it. No worries. I'm insured. And the problem is insurance is not always an answer. The board is ultimately responsible for all operations, maintenance works, landscaping, general repairs, budgeting, enforcing the rules. That's their job. When they fail to do this or they do it incorrectly, there's a likelihood that a D&O claim will be filed. And when we talk about D&O claims, we're talking about things like failure to enforce the document, failure to have a reserve study, breach of contract, diminution in the value of the unit, and breach of fiduciary duty. And that's why we say D&O is important, because it provides that peace of mind. It allows you to sleep easily at night knowing that if you're sued, you can be covered. So there's three things I want you to remember right off the bat. The first thing is that D&O insurance protects the board when they are performing their duties as a board member. It's their professional liability insurance that protects them for decisions or lack of decisions they make. D&O insurance is unique and unlike other insurance because most insurance policies is for accidents, not the D&O contract. The D&O responds to business decisions, like this board deciding to tow away a car because it's been parked in business parking. That's what D&O is all about. But it's important to note that the policy will not cover any deliberate, fraudulent, dishonest act or any purposeful violation of any state statute or regulation. Number two, it's there for your defense. It's there for your defense and settlement in case you're sued for, again, the decisions you make. It's not there to repair, replace your roof or other damaged property. If a board is sued under the D&O insurance for property damage or the gradual deterioration of common area, then coverage could be denied under the D&O contract. The third one is D&O insurance is there to give you that peace of mind, but it's not there so you can be reckless and do whatever you want because you have insurance. Not all D&O insurance policies are alike, and some are significantly broader than others. So it's important to know what wise decisions look like and what foolish or reckless decisions look like in case the D&O insurance is not broad enough to respond. So Rob's talking about reserves and what wise behavior looks like. Now, everyone wants to be so far. Okay, let's try that raised hand thing if you're following me along those three important items.
Fantastic, Kevin. Everyone's tracking.
Okay, good.
Okay, all right, I'll put hands down. Thank you all very much. Okay, deterioration is real, it's predictable, and it occurs on an ongoing basis. And what's important to note is that a day at a time or a month at a time, the cost of deterioration is not expensive. And we've got some attendee homework for you at the end of the session. What we want you to do is check your governing documents and see the section under board responsibilities to see if it actually says, per your governing documents, you have a requirement to adequately fund reserves, or how it describes your funding responsibilities. And you also need to look around and see what the reserve study requirements are in your state. Make sure that you're aware of what those written responsibilities are. And those are the kind of things Kevin's been talking about, that acting on behalf of the association in your job. It's like the professional liability. I think Kevin's words were professional liability insurance. You need to know the standards that you're going to be measured against. But in addition to those measurable written standards, there's some practical issues. And the first is that there's a general fairness to the owners when you're setting assessments so that everyone pays their fair share of deterioration during the time they own a home in the association. And second, there's a general responsibility, as I said, to maintain the assets of the association. That takes money, and wishful thinking doesn't pay the bills. And reserve projects grow over the course of many years, and so you need a multi-year plan to gradually prepare for those large expenses. And that plan's called a reserve study. It guides your association's budget across those many years, gradually into the future. So the bottom line is that board members need to set adequate contributions on a practical level, and it traces back to their fundamental responsibility to provide for the needs of the association. And let me share with you what we see as far as what associations out there are doing. This shows, actually now that I'm looking at it, it's kind of busy, but percent of total budget that needs to go to reserves among our clients. So we did a data gathering, a data analytics, I guess, to find out what associations need to be setting aside to adequately fund reserves. And you can see most associations need to be setting aside anywhere from 15 to 40% of their total budget. So it does take a substantial amount of cash for your association to be ready for those future expenses. If you're going to pick just a number, you might want to say about a quarter of your total budget. So remember that. It's a pretty simple number. And you may be reeling, wow, Robert, did you say 15 to 40%? And yes, but remember, that's still not a lot of money. For a typical condominium, that means about $3 to $5 a day set aside towards reserves. And that's about the cost of a premium cup of coffee. And if you or your homeowners can afford a premium coffee, you can afford adequate reserve contributions. It's just part of the cost of owning a condominium, and from a board member point of view, running a community association in today's world. And again, you may think that that's a lot of money, but the expenses are going to happen whether you budget for them or not. So the homeowners are going to pay either on an ongoing basis with budgeted reserve contributions or through that dreaded special assessment. They just can't be ignored. If you ignore them, they don't disappear. The cost of reserve deterioration is as real as any other bill at the association. It's just a bill that needs to be paid. So I just want to summarize this section here. There's some decisions that can be measured against a written standard, and those decisions are the ones that can be measured against your governing documents or state law. And then there's other decisions that you make that are measured against general principles of fiscal responsibility. And those are like providing adequately for the reserve needs of the association.
Yeah, when you're talking about, Robert, you're talking about the board's fiduciary responsibility. It's their job to maintain, enhance, and protect the assets of the community association and make informed decisions about managing the association. The problem is when they are not doing their job correctly. They can be sued for breach of fiduciary duty, and that's why the D&O policy is critical. So when we talk about the D&O contract itself, the D&O protects the insured when a claim is made against them, the board, because of an act was they're accused of something that's not in the best interest of the association. Now, there are several types of D&O policies available. They generally fall into two categories. It's the bundled or the standalone policy. First, the bundled policy, which is a package policy, where the D&O policies are covered by endorsement to the property and liability policy, is usually at a lower cost. However, coverage is significantly restricted. Second is a standalone D&O policy that's broader than the package policy, but you have to be careful because sometimes these are not designed for community associations. They're designed for major corporations and nonprofit. But you have to be careful because these standalone policies and these bundled policies exclude claims that the community association may need. Let me give you an example of that. If the board fails to fund the reserve after the reserve study, and several unit owners sue for a judge to decide if the board acted improperly or not, for the failure to fund that reserve, then some D&O policy will deny that claim because the claim itself never asked for damages. When we talk about the D&O contract, there's something called a non-monetary damage claim, which is the most important and most common type of D&O claims out there for community associations. And most of these policies exclude non-monetary damage claims under the D&O policy. So if they're asked for damages, there's no coverage. So what you need really is a specialized D&O policy that's designed for community associations that deals with the unique exposures that community associations face. So when we talk about D&O insurance, we talk it protects the insured against a claim for a wrongful act made against them. That's the coverage you are buying, a wrongful act policy. So when we talk about a wrongful act, we're talking about any act the insured can be held liable for. Often this comes to things like breach of fiduciary duty, arbitrary enforcement of the association documents, failure to enforce the rules. These are examples of wrongful acts that the policy needs to respond to. That's why it's critical to understand the D&O policy, and when coverage will not apply, boards can be sued for any reason. But they limit their exposure when they run the association in line with the responsibility as a board member, acting in the best interest of the association, about conflict of interest, and in line with their documents.
Fantastic. So that's a reminder to basically do what they're supposed to do what they were elected to do. Well, along those lines, reserve studies exist to help the board know what they're supposed to do. Basically, when they get to a budget point, they ask themselves a classic question, what do I do now? And that's one of those important decision points, and that's what we're going to be focusing on all this session here today. Those financial decision points, either during budget time of year or throughout the year, when they're facing a different expense, one or another type of expense, wondering where the money comes from, and they're always asking that question, what do I do now? Well, reserve studies, as I indicated a little bit earlier, tell the board how much needs to be set aside on an ongoing basis in order to prepare for those inevitable upcoming expenses, and the reserve studies help guide the board towards where to draw the funds from to pay for that expense. It's kind of like boiling down to, I think of it like Goldilocks and the Three Bears. You need to find out what size contributions are just right for your association. Not enough, not too much, but just right for your association. You don't want to be guessing, and guessing is not a good or safe way, as Kevin's talking about risk management for your decisions. Guessing is not a good or safe way to operate as a board.
You're right, Robert. Having the right amount in reserves is a great example of that major responsibility of the board. But what we see is boards ignoring this very important issue. Things like deterioration in the common area is a major concern today. Because it's important to understand that deterioration, a claim for deterioration can be excluded under the D&O policy and your general liability policy. For example, a claim against the board of directors for breach of duty because the fences need repair, pool needs work, the roofs are in neglect, coverage could be excluded under both policies. Most D&O policies out there have something called an absolute bodily injury and property damage exclusion, and will exclude any claims arising out of, attributable to, bodily injury or property damage. So a claim of this nature is usually reported to the D&O and the GL carrier. D&O may say no. The GL carrier will ask this question: when was their occurrence? Meaning, when did the accident happen? And with deterioration, there is no occurrence date, so there is no loss. See, because of this, it's more important than ever that the board act in a fiscally responsible manner and understand the significance of deterioration in community associations, because it's the one area where coverage may not be available. Again, the problem is that too many boards spend way too much energy focusing on pets, parking, and noise instead of association well-being. They treat serving on a not-for-profit board of directors as a hobby or social club where they discuss their favorite book or movie. All right, Paige, I guess we should launch that poll now. What do you think?
Let's do it. All right. One more poll for you all. What is limiting your reserve contributions? Please go ahead and make your selection. All right, we'll give them a couple more seconds to submit their answer. Okay, and it looks like Quite a few answers here. The leading one is perceived assessment increase limitations, followed by staying similar to prior assessments and no limits. We do what we need to do.
Good for them. Okay, well, Paige, that's fun. It's great to hear what people are thinking, what people are doing. And let me just talk about reserve studies for a moment. Just like the association needs D&O insurance, every association, hopefully we've made the point that every association needs an updated reserve study to learn three things. Basically, it documents the condition and the projected cost of the reserve components, when they're going to happen, a calculation and evaluation of the reserve fund strength, basically how are we doing, do we have enough, and the third is a multi-year funding plan, which we've been speaking about, showing the recommended contributions needed to offset that deterioration and help make sure the funds are there when needed. And just like the three results from a reserve studies, there's three types of reserve studies. And for those of you who aren't familiar with them, there's three types called the full reserve study that's created from scratch when no reserve study exists. And for that, a site inspection will go through and do a real detailed evaluation, inventory, assessment, all those kinds of things. Once that's done, you can get by with one of the two different update products. The update with site visit means going back and revisiting the site, diligent visual site inspection, and just updating the component list that's already been established. And the third is an update no site visit, and that's updating the existing reserve study on the basis of time that's elapsed, refreshing it based on interviews with management, with the board, with major vendors, those type of people. And most of all this means is that most of the reserve studies an association will do over its years are the update types. And they're either the with site visit, interspersed with some no site visits on the in-between. And all of them are going to tell you the information that we've been talking about, which is boils down to, in most board members' minds, that recommended contribution rate. And that's that deterioration bill that needs to be paid.
You know, Robert, what if the board doesn't think they can afford what you recommend?
Yeah, just like that poll that we asked, if they have some limitations. Well, if they underfund the reserves, hopefully we've been making the point that the bills need to be paid. And if you aren't paying the bills, then the bills are going to get ahead of the reserve balance, and that increases the chance of a special assessment. And you can see on this chart, it's the national special assessment risk. I've plotted it on a percent funded scale with a low percent funded, 0 on the left, and a high percent funded on the right. 100% is ideal, 0% means they have no money. And you can see, not surprisingly, that the risk of having a special assessment increases as you move off to the left, because with less and less money you have at your association on a relative scale, the more risk you have to special assessment. Fundamentally, you just run out of money to pay those bills, and the money's got to come from somewhere, and so that means special assessment. And but let me kind of toss that question back to you, Kevin. What happens from a D&O insurance point of view if the board doesn't budget the reserve contributions that are recommended?
Okay, well, what happens normally, again, when we get involved, it's because a claim is made against them. But the question, and our question is, was the decision made without conflict and the best interest association? It's something we call the business judgment rule. And because it's their responsibility to act in a prudent manner. If not, they're going to be sued, and damage could be tremendous. So the problem, though, from here is that, again, there's specific exclusions that would apply that restricts coverage. So you can't make a unwise or foolish decision, because that's when you have money. Like, one of the exclusions that really can impact some of your decision making is something called the prior acts exclusion. You know, there's a prior knowledge exclusion in all D&O contract that could exclude prior acts. This is important because when reserves happen over a period of time, about full prior acts coverage, then the failure to fund reserve can be excluded. It's like pre-existing conditions in healthcare. Therefore, board members must act in the best way possible, just in case coverage is not available.
So what we're talking about here is a board's responsibility to make those fiscally sound decisions along the way when they're seeing those indicators that, yes, the deterioration is happening. They need to keep up with it because it's not a specific, what did I write down? Specific incidents. And that's interesting because the reserve deterioration happens over time, and it's a matter of trying to convince the board to make the wise decision to offset that ongoing deterioration with ongoing contributions. But let me ask, what if that's just plain the way the association's always been doing it? That's their characteristic of their association. They've been limping along with marginal reserves, marginal maintenance, kind of a rundown property, special assessments. What happens then?
Okay. What we're seeing is more and more breach of fiduciary duty claims against these board members because there's lack of upkeep that you just mentioned. Associations are getting older and too much of these things are being ignored, which result in more and more claims against these board members. Okay, see, my goal today is to provide you with information you need to make these better, informed, wise decisions. Because even if you're defended, that whole headache and time of a lawsuit is something you rather avoid. What we're talking about here are decisions like having a reserve study or making necessary contributions. But let's talk about adequate reserves for a moment. Is it a simple thing to measure, Robert?
Well, I wish it was a simple thing. The FHA has said that they want to see 10% of budget going towards reserves, and I showed a chart there that showed reserve fund strength and special assessments based on percent funded, but there's really two parts to having adequate reserves. One part is making the adequate contributions, and the other part is the resulting size of the reserve fund, hopefully large enough to be able to pay that roof replacement bill. So because it's not a simple question, I got together with a committee. A group of us had just updated National Reserve Study standards, and we did some wordsmithing, and we came up with the definition that you see on screen. Being adequately funded means two parts. More like a test to see if your reserve contributions and reserve fund fit the definition. It means not having high contributions that are necessary because your fund is so small, but on the other extreme, not having a good and strong reserve fund, but then being reckless and not funding reserves for the future. But at least now we have a national definition that boards and managers can compare the reserves against. I hope that you can take a look at this and think, are we setting enough aside that we won't have a problem in the future? And how does our fund by itself measure up? How much risk are we at for a special assessment at this time? But Kevin, let me bounce this back to you. What if the board in their best judgment, okay, they're trying to make a wise decision here, feels that they can't budget for the recommended contributions because it's just plain too big of a change to make. I want to give them some guidance because there's going to be some people here today that are wondering, wow, how do we want to do the right thing, but how do we make such a big change?
Okay. To truly protect the board of directors, really protect them, they need to face the facts that at least have a plan. You need to start with a plan. The first step is to at least review the reserve study and make sure it makes sense. Because when it comes down to it, what we're going to do is look at the decision. When that claim occurs, the decision, the process for that decision. Was it made in the best interest of the association? Was there self-dealing involved? Was the plan discriminatory? Do you treat some people better than other people? Those are things that we need to look at. But again, if the board is doing their job properly, if they take the steps that they need to take, then we should be in pretty good shape. You need a wise plan, not a foolish plan. And that's what it boils down to.
Yeah, I got a kick out of this cartoon. This tends to me speak directly to a foolish plan, not being wise, not putting the numbers down. And you've seen this before, right, Kevin?
Yeah, I did. Yes.
Fantastic. Well, some of the people attending have heard a plan that we've discussed in the past. We call it the $10 solution. And most boards in underfunded associations realize that they're in a bit of a financial hole, not due to their own problems. It's due to trends over the last years or decades. And in many cases, you don't have to make an immediate solution, an immediate overwhelming change. So what we're talking about here is making wise decisions and having a plan. And quite often it's responsible to take a few years to implement the plan and gradually increase reserve contributions over a few years until they're large enough to offset deterioration and provide for those reserve projects. We call it the $10 solution because it means increasing your reserve contributions $10 a month this year, and then I should say $10 per month per owner this year, $10 per month per owner next year, gradually working up the plan, and over 3 or 4 or 5 years, getting on the right course so the association is offsetting that ongoing deterioration. Let me ask you guys a question. Give me a hands raised if you're tracking that you may be in a jam now, but you don't have to solve it all at once. You can take a few years to gradually increase reserve contributions and get on track. As long as you have a plan, it can be a multi-year plan. Okay, great. Thank you very much. I'll put hands down.
Yeah, Robert, some people are concerned that if they raise the assessments because of the reserve contributions, some people just can't afford to do it right now. But there are two parts that are important you got to make. The first one is the boards need to do their job. They need to pass the budget. They need to fund the reserves. They need to do their job. And each unit owner also need to do their job and decide how they're going to pay their assessments. It's not the board's responsibility or their job to make budget decisions on behalf of individual unit owners' own financial conditions. They have to make those decisions because it's their job to do it.
Yeah, that's kind of tough love, but it's the kind of things that need to be said. Well, let me tag along with the theme of things not being affordable. There's a lot of talk now about sustainability, and we often hear it with respect to energy and recycling and being green, but sustainability is also a budgeting word, having adequate funds to pay the bills of the association so you don't create a future crisis for other people. So underfunding reserves does create a problem. You want to avoid that because underfunding reserves results in higher net costs because projects are going to be more expensive when they're deferred, scope creeps, and all of a sudden, instead of, for instance, just replacing a roof, you have a bunch of water damage to pay for. There's loss of curb appeal and home value. There's owner discouragement, disappointment, and discontent. Basically, a lot of bad political things, and you end up losing out on the peace of mind and the enjoyment of living in a community. But then on the other hand, there's some pretty good consequences when you have adequate reserves, when you've paid those extra few dollars more a month and you realize projects get done on time, the expenses are minimized, everyone's paying their fair share, the special assessments are rare because you're collecting from everyone a little bit at a time along the way, and for the point of today's session, board liability is minimized.
And that's the good part about the whole thing. The problem is though, we find out that most people don't do it that way. You end up with a situation where you have the current board going against the prior boards for not setting adequate budgets. You really can't blame this new owner being upset by having to pay a special assessment for something that occurred over 20 years ago and could have been prevented if the reserves were adequately funded.
And the prior owner had paid their fair share of reserve contributions along the way.
Exactly.
Yeah, that starts to look reckless. Well, what do you think? There's also another consequence, and that's won't a claim also affect the operating budget in premium change?
Exactly. And that's really important because what we're seeing, not only higher premiums, but you have more restrictive coverage out there. You will see claims that start to come in, and the insurance provider will say, okay, from now on, we'll not pick up certain types of claims, which has been happening over years. So you'll have higher deductibles, you have more premium, and less coverage as a result.
Yeah, all bad things. Well, let me turn the corner as we start to bring this webinar to a close and give our audience some suggested tips for success. Well, I indicated that earlier in the homework. Know what your governing documents require, know what state law requires, get your reserve study updated so you can see what your numbers are. Choose your words carefully. And by that, I mean, don't talk about reserves being savings for the future. Talk about reserves being for the bill of deterioration. So it starts to sound more like any other regular bill at the association. And look at your D&O policy. Have a discussion with your agent about what is and isn't covered. Kevin touched on that earlier. Kevin, anything more to say?
Sure. And you need to know your responsibilities. You need to know your written, you need to know what's going on out there. Don't get distracted trying to make individual owners responsible. Communicate often. Communicate, and avoid reckless decisions because, again, your D&O is peace of mind insurance. But as we said before, there are exclusions in the D&O, things that may not be covered. So as long as you act responsibly and do your job as a owner of the, or being responsible for the board of directors or being responsible for the community association, and don't treat it like it's a hobby or something else. So again, I think that's the key points of it. Insurance doesn't provide all the coverage you need. You have to know what you're doing and do the best job you can.
Still have to operate responsibly.
Exactly.
Well, I want to thank Kevin. I always gain so much from his insights. I've got a script here, and I've been marking it up with all my notes. Hopefully, we've made it clear that the board's job is to run the affairs of the association. They need to set the assessments, I think as Kevin said, per the board's responsibility. The board needs to make their responsibilities where the assessments need to be. Don't starve the association of the funds it needs to thrive, because when the association has the funds it needs, the property values are going to be maximized. Focus on making the association a great place to live and get the peace of mind that comes by you as a board making those responsible, wise decisions. And that's a great service you can provide to the owners. That I think is how we can summarize what we've been trying to communicate today. So on behalf of Kevin and myself, we hope you've picked up some tips about how to move your association forward successfully in a financially responsible way in the manner of the decisions that you make. Now, our websites are listed on screen in case you'd like to have some follow-up information or if you'd like some help with your association. We don't sell courage, but we help with the information you need to make wise decisions and help guide you into making those responsible decisions and insurance coverage that you need that will protect you as you help your association move successfully towards the future. So at this point in time, I'll turn the microphone over to Paige, who will coordinate our Q&A time in the remaining time. Paige.